It's important to think about what's least likely and most likely to happen when you use a hedge. The least likely outcome is for both of them to profit. Okay, that's very rare. So you shouldn't be trying to make that happen.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
You're here at the Two Traders Podcast. I've got Darren on the line. Hello there, Darren.
Hello, Walter.
Well, last time, Darren, we touched on your hedging strategy, and I know this is something that a lot of traders use or have considered using, and I've always found it a bit tricky. So I just wanted to get your thoughts, and what can you do as a trader? First of all, why would you use hedging? Why is it even something you use? And then secondly, if you're thinking about using hedging, what are some of the things, the pitfalls, what are some of the things that traders need to know if they're getting into this?
Yeah, I just had an email this weekend from someone who asked me. I emailed him back about hedging, and I said that not being able to hedge put you at a disadvantage because he was in the States and his broker wouldn't allow him to do it. And he asked me the question and said, okay, so how are we at a disadvantage not being able to hedge? And it was really difficult for me to answer that question because it's quite complex in my head, really. But the way I see it is, let's say we trade trends. Let's say we're a trend trader and we are, selling the pound dollar. We've got a position. It's in profit. And, we come to a certain scenario that's making us think that we should take profit. But at the same time, we want to stay in this trend, and if we exited, we'd feel, and price continued, we'd feel really bad about that. So what I would do is I would hedge my position. Okay, so if price did then reverse completely all the way to your entry level, you're basically in the same scenario, give or take a few pips, that you were originally. Okay, so your short position has retraced by 100 pips, but your long position is 100 pips in its favour. And I think when people look at it, they'll say, well, you could have had 200 pips there if you'd have exited and reversed. And that is strongly using hindsight bias, and they're missing the point, which is at the moment you need to make that decision whether to exit your short trade or manage it. The hedge gives you that sort of third opportunity of basically kind of hitting the pause button, and you're still protecting your profit that's locked in, but at the same time you're giving price that opportunity where it continues to fall and you get a much bigger win. Obviously you lose your hedged position, and sometimes that will make a difference, but I think there's a lot to be said for having that ability just to, when you've got profit on the table, to hit the pause button and just, perhaps wait for some more price action, perhaps wait for the next sort of major trading session to start, perhaps just for you to be able to make some sort of better analysis of what's going on with a clearer head. And I think it's got a really negative view. There's like a negative opinion on hedging the same position. How can that be advantageous? But that's kind of looking at it through a very, from a one-dimensional point of view, where you could have made more money if you just stopped and reversed. But like I said, that's hindsight bias, and that's being able to predict what the market does. And if you can't do that, which is what I believe, nobody can predict what the market's going to do, then hedging is a really good option.
Yeah, I see it as sort of advanced trading. It's sort of like a graduate school trading, really. And so I'm fascinated. I have played around with it, but my question is, in that situation, let's say you're in a situation where you're shorting the pound, and then you want to lock in that profit. You're not sure if it's going to bounce and go up, so you get a buy position on, and now you're hedged and you've locked in that profit on that short. Will you try and trade your way out of the second position, the hedge position, or will you just dump them at the same time? Because it sounds like what you're going to do is you want to at least lock in that profit. So at the very least, if the market goes straight up, you would dump both of the positions, right? And then you would have locked in that profit. But if it were to go up for a little while, and then start to come back down, in other words, go in your direction, I suppose eventually you would drop that hedge and just ride out the original position, right?
Yeah, one of the traps of it is like you say, trying to trade out of the hedge and get away with both trades being profitable, and that is your gut instinct to do that. Generally, if I take a hedge on, I'm looking for price to move out of that range that you've defined, really. So for one of the trades to become a loss, and then price to continue, and hopefully your original short trade becomes much larger, covers the hedge, and everything's rosy. I did for a while look at ways of maybe I should move this one to break even now, and maybe I can kind of always get out with 2 profit trades, and that's tempting to do, but it's not necessary, and it kind of overcomplicates it. So really, once that hedge is in place, I'm waiting for price to move out of that, and one of them become a loser, and the other one to continue on. But something I do is I will trade within that hedge as well. So, for instance, if I was short and then I had a buy signal, I'd take the buy, and now I'm hedged. If another short sets up whilst that hedge is still in place, then I'll take that trade as well, because that hedge has no bearing on that next trade. Because if I just started trading at that point, it was a valid setup, so I should still take it. So I do trade within the hedge as well, and that happens quite a lot for me. So with that kind of lower swing low, lower swing high sort of movement, I'll quite often end up with 2 positions short when it finally breaks out. That's the ideal scenario. Obviously, it doesn't always work out that way.
Right. So in that scenario, the market starts to go lower. You take a short, and then it starts to bounce and go up. So you take a hedge. So now you're hedged. You've locked in that initial profit. Then you get another short signal, and then you short it. So you got 2 shorts and 1 long. My question is, when would you dump the first 2 positions, which is the hedge, the short and the long? When does that get dumped? When the second signal is dumped as well? Is that when they're all dumped at once, or? Yeah. Do you know what I mean? Like when the second short is dumped. So let's say it goes down 100 pips. All right, I short it goes down 100 pips. Then I think it's going to go up, and it does go up, and it goes up 40 pips, right? So I've locked in the 100 pips on my hedge. It goes up 40 pips. Then it gives another short signal, so I short it there. And then it goes down another 200 pips, let's say. So I'm up 200 pips from on my second short, and I'm up 260 pips from my original position, but I'm hedged 100 pips on that, right? So do you know what I mean? How do you get out of that? I'm fascinated by the execution of the rules of this.
Yeah, well, generally when I was too short, so when the long got stopped out and now I'm 2 positions short, then obviously a strong reversal now would be, I'd be carrying twice as much risk. So I'd obviously then, I'd manage one of those trades more aggressively, either moving to break even. But generally what I'll do is I'll wait for another long signal to set up, and when the next long signal sets up, then perhaps I'll take the second trade off as profit, and then repeat the process again. And you can keep doing that, ever expanding hedge, but again, that only works if the market just keeps trending, and at some point it's going to come all the way back to the first trade. So at some point you've got to say, that little sequence of trades played out, it's cost me X amount, I've got this amount of profit on the table. Well, just take the profit off the table. That's your end goal, is to be in a profitable trade. At that point, you can take your profit off. Does that make sense?
Yeah, no, it makes sense. Yeah, I guess it sounds like one of the traps is, like you say, you want to trade out of that hedge, because it's insurance, isn't it? I mean, it's like an insurance premium where you want to make sure that you don't lose that profit that you had on the trade. So that's why you hedge, and you're going to have to pay that. You don't want to look at it as another trade or another opportunity to make money, right? You don't want to look at that. It's more of just locking in the profit you've already got.
Yeah, I think it's important to think about what's least likely and most likely to happen when you use a hedge. The least likely outcome is for both of them to profit. Okay, that's very rare. Okay, so you shouldn't be trying to make that happen. The other least likely event is for both of them to stop out. So to go all the way back to your first trade, stop it out, and then drop all the way back down and stop out your second trade as well. That's the least likely. What's going to happen 9 times out of 10 is when you have a hedge like that, price is going to move out of that range, and then you've got an opportunity to take profit. And so, really, you just have to wait for price to move. In the meantime, if a valid trade sets up within that range, then by all means take it. Sometimes I'll just leave it. I'll say, okay, look, I've got this hedge set up. Price is kind of going nowhere in the middle of it. I'm just going to wait until price moves. And then when it breaks out, okay, then I'll assess my position and the profit and the losses and then make my exit decision.
Right, that makes sense. And if for someone who's listening from a place, a country, we won't name names, where you're unable to hedge, one suggestion would be just to get another account, right? So I mean, why not just have one account where you're taking your trades and another account where you're potentially hedging those same trades? That's a solution, right?
I think that's the solution, or you have to go with an offshore broker. Obviously, there's downsides to that as well, but I think some of them are really good now. I mean, I hear people talking about it, and I think some people are quite happy with some offshore brokers as well. Obviously, do your research on that. Yeah, I think the only way to go if your broker or if the country you're trading from won't allow you legally to hedge the same currency pair, then yeah, you have to I suppose you have to have 2 accounts and trade one as your short and one as your long. I don't like that overcomplicating the actual process. That's a little bit annoying, but I think it's a really good way of trading, and it's a really good tool to have in your toolbox, no matter how you trade. If you trade like off support and resistance, or you trade, I mean, how many times have we've been in a really good short and we're watching, all right, I know it's going to this support here, and that's where I'm going to exit. And how many of those did you like? Brilliant! I got the exit I wanted. It's bound to reverse here, and it continues on. And how many of them would you have been able to like take on a 30 or 40 pip hedge there and just let things play out a little bit? So I think it's a really good tool, and I don't think it's used often enough.
Yeah. So the main mistakes, the primary issues when applying the tool would be, don't look at the hedge position as an additional profit. It's really just insurance, right? Well, what else would you say is tricky here? Like, what are some of the things that might be mistakes?
I think really, like you were saying earlier, trying to trade out of them. There is a gut instinct when, say perhaps we had this hedge, I'm short from 1200 and I'm long from 1100. You've got, say, 80 pips locked in there. And sometimes price will spike out your long trade and then reverse again. And I think, that's quite hard to take, where you've sort of gone through the process and and now you're going to end up with even less profit. Quite difficult to follow your system then. I see a lot of people getting drawn down the notion that trying to move them both to break even when prices in the middle of the range is somehow advantageous. Maybe it is. I find it very hard to believe in all my testing. You're much better to let the hedge move out of the range and stop one of the trades out. And really, I think just find how it can kind of fit in with how you trade, because we're all kind of trading slightly differently. I'm surprised trend traders don't use it more. I think it's excellent as a trend trader. You never know when that trend's going to end completely. You never know when to close out all of your positions. If you've got a really nice, big win, it's just a great way of saying, I'm just going to put the pause button on here and just see. I've got a feeling this trend could go on a bit longer. For the sake of 50 pips, when you've got a nice big win, or whatever, is I think it's just a really handy tool to do. And often when you need to make those decisions, it might be at the end of a long trading day or a long trading week. You might not be in the best frame of mind at that moment. You might want to do some more analysis. You might just want to wait for perhaps a news release that's coming up that will be key. So, it can be a really good tool for trend traders as well.
Yeah, that's a great point. And I think that one of the things that I really like to use as a tool, which is basically what hedging gives you, is this idea that you just wait another candle. And so some traders might be in a let's say some sort of trend trading position and it goes really far, and then they're not sure. Maybe it hasn't triggered their trailing exit yet, but it kind of looks like maybe things are going to turn around and go against them. By using that hedge, like you say, you can lock in that profit. So I guess in practice, then you would dump both positions if it were to get, say, back close to your entry price, right? In your original position. Is that basically how you do it?
Possibly, I'd perhaps wait to see if price continued in that direction. What you'll find often is you'll have a short and then you'll hedge it with a long, and price will come right up to your short again, and then it will print a second short. Obviously what's happening there is price is ranging, but I get that quite often, and then it'll go all the way back down to the long and I'll win 2 positions there. And if you work your way back through it, you say, well, I should have just exited the short down there, and then I should have gone long and exited there, and then I should have gone short. But it's very hard to do that. It's very hard to pick an exit like that and then reverse it and go back in the other direction. So essentially, there's loads of variants of what's going to happen when you take these hedges. But you can often have a profitable outcome as long as you're not trying to get the maximum out of every move and be happy with a decent net profit. Then it can be a really good tool.
Yeah, absolutely. Yeah. Thanks for sharing, Darren. That's really interesting. I think that some of the traders out there who are thinking about this, that definitely gives them a starting place, because, like you say, it's so easy with hindsight bias to look back and say, oh, well, you should have just done that. But you never know when that signal prints how far it's going to go. So, yeah, that's fascinating.
Okay, Walter. See you next week.
See you next time. Thanks, Darren.